Hi everyone, welcome to the Trading with Ashley show. You're going to love this video because you are going to see in this video how you can leverage earnings to get the stock of your dreams at a fair price. But even better, I am going to teach you how you can, selling puts on this one particular ticker symbol, you can triple the amount of premium you make without taking on any additional risk. I know it seems too good to be true, but I have figured it out. I have shared it with my Discord members. We were in some of these trades today, so I wanted to make a video about it so that I could clue all of you in on some of the exciting things that we have going on in the Trading with Ashley Discord. By the way, if you want all of this information real time and you want access to all of my trade hacks, really consider joining us. We are a growing community and everybody is super happy within the community. But most importantly, everybody is learning so much. Now, for those of you that want to know more specifics on how to trade for a living selling options, I will be announcing a bootcamp very soon. If you want the first opportunity to join those bootcamps, they fill up super quick. You want to go ahead and join our Discord now because they will have the first opportunity to get the spots before I open them up to the public. Palantir has earnings coming up on February 3rd, and you'll notice if you go and try to bet on earnings by buying a call or buying a put, you are paying an elevated premium if you go past that February 3rd date. And I actually don't advocate doing that because that is a directional bet. It's very risky because if you selected the direction wrong, you overpaid for the call to begin with or the put because of the high IV. I'm on the other end of the equation. I'm an option seller in these scenarios. And what I like to do, I like to take advantage of getting more premium to make my trade more profitable for me. But first, you have to decide if you even want to trade over earnings. So I want you to ask yourself these questions. Is Palantir a stock you want? Do you want more Palantir, but you want it at a fair price? If so, trading over earnings could be something that really helps you. For one, if the stock price dives after earnings, so we're trading in the mid 70s to the upper 70s right now. Let's say it pulls back dramatically. What is the price that you would say, I'm a buyer if Palantir gets to X price? Once you have that number in your head, earnings could potentially provide that opportunity for you to get the stock at that price. So what if I told you there was a way to take it to the next level? You could actually sell a put at your number, the number you're comfortable owning a stock at. And if it dips down to that price and you're put the shares, then you get that stock and you get it at your price. So you could just wait to see what happens after earnings. And if it dips, you could just go in and buy the stock. Or you could get paid for putting your money on the line to buy the stock at the price that you said you'd be comfortable owning it at. I like trading over earnings in those scenarios when I want a stock anyway, and I am looking at a price that's well below where it's currently trading. So in this case, I am looking at Palantir. I know earnings are February 3rd. I'm actually going out a little bit further for two reasons. One, I want the extra premium that comes with pushing the trade out a little bit further. And two, if we overcorrect, let's say we pull down well below my strike price, I want a little time to pass where buyers just step in and push the price just a little bit higher so that if I'm put the shares at the price I want, or if I'm not put the shares and let's say that Palantir takes off, then I have gathered some incredible premium that I can turn around and use it to buy Palantir. So that's the general premise of why you might consider trading over earnings. I definitely would not put my strike price right below our current pricing. You could be holding shares for a long period of time while you wait for the stock to go back up. So what I'm going to do, I'm going to take you into the computer. We're going to look at the technical analysis. We're going to identify a fair price to own Palantir. Then I am going to take you to the leveraged ETF counterpart. We are going to compare the pricing of Palantir at a fair price, but how that equates in the leveraged counterpart. Then we're going to go into the option chain and look for options to see what kind of a return we can get trading Palantir or trading its leveraged counterpart. Again, we're going to use similar dynamics, so we're comparing apples to apples and we're not taking on additional risk. We're just after getting some great premium at a fair price. Our first order of business is to go look at the technical analysis on Palantir so we can determine a fair price to pick up the shares if we see a dramatic pullback after earnings. So to do this, I'm looking on the 3-month chart. I'm on the Robinhood charts, and I have my Bollinger Bands populated along with some moving averages. And so the first thing that stands out to me is right here at the RSI. We're currently up at the top of the RSI. We're at 60. By the time we get to 70, we are in an overbought situation, but there's still a lot of bullish momentum behind this stock. And so typically when we're over 50 on the RSI, I like to look at the middle of the band for support. However, we are trading over earnings and I want to be as safe as possible. So in this scenario, even though we're high on the RSI, I am going to look towards the bottom of the band. And that gives me right at about that $64 level. However, as I want to go down a little bit further just to be even safer, I want to more than likely go below the band. $60 seems like a great level here because it's not only below the band and it's sitting right on top of an important moving average. This is the 100-day moving average. It's at about 57. So if I went with 60, this would be good because it's a psychological level. One thing I noticed that the last time Palantir pulled back dramatically, once it got under 65, it started to be purchased and it was bought up pretty quickly. So there may be more buyers if we get down below 60 that would then propel it back up. So I think something around 60 is a really decent spot and it's quite a bit of ways. So if we were to see that type of a dramatic pullback, I would not mind owning the shares. Even if I didn't sell a put, I would probably be buying the shares at that point anyway. And so the beauty of selling a put is I'll get paid in addition to getting the shares if they pull back. So now that I have a target price in mind for Palantir, I want to take you to the next step of looking at how we might consider selling a put and getting more premium for it. For this next step, I am on Google Finance. They have a great feature. It's the comparison chart. So I've got Palantir pulled up right here, and I want to compare the price action to the leveraged counterpart, PTIR. It's 2-time leveraged ETF for Palantir. And the reason I like to put them on the screen together, I want to see what PTIR will be trading at if Palantir pulls back to $60. So I see that right here. Do you see on November the 13th, it looks like Palantir was at $60.70 and PTIR was at $89. And so I want to go look for a strike price that is around that $89 level. And that would be what it should be at if Palantir pulls back to around that $60 level. Our first stop on the option chain is going to look at expiration dates. Now, we know that earnings is going to be February 3rd. So I want to go beyond that because for 2 reasons. I'm going to go to the 21st. That's the 3rd Friday of the month. And that provides a lot of insight into what institutions are doing. Also, when I'm going to look at the ETF, it only trades on the 3rd Friday of the month. So I want to make sure I'm comparing apples to apples. The other thing is, if you're trading over earnings, you're dealing with a lot of volatility. So I like to go at least 2 to 3 weeks out so that I can go lower in price for a margin of safety, but also IV will have died down at that point, and then that makes it easier to get out of the trade because as I sell it with high IV, I'm getting more premium. I want to buy it back with low IV. So that helps if you go a few weeks out from earnings. So let's start with the $60 strike on Palantir because that's what we had looked at. And the first thing that stands out to me is this is a popular strike price. It has lots of open interest at 21,000 versus look what's before it and afterwards. The only other thing that shows a little bit of significant interest is right here at the $50 level, but there's such a big gap between 60 and 50. So I would not want to go with the 50 because it's just too far below where the current strike is, so I wouldn't get any premium. If I look at my deltas, because that's an important part of the equation, I always like to stick to at least a 0.2 level or lower, especially over earnings. Well, this checks that box because it is actually below 0.1. And that's helpful because the lower the delta, the lower chance is of assignment. But again, I do want assignment, so it's kind of that double-edged sword. The sweet spot, if you're not trading over earnings and you want assignment, would be closer to about 0.3 to increase your chances. If we are going to go with $60, it looks like I will be getting about $74 to sell this put. To sell the $60 put, I would have to put up $6,000 in cash so that I would be able to take ownership of the shares. So let's calculate our return if we were to sell the $60 put expiring in 3 weeks from this point, and I were to receive $74 in premium. To do this, you take 74 cents and you divide it by 60 because that is the amount of the stock. That equals 0.012. You multiply that by 100 to get the percentage. That's 1.23. Now, because this is a 3-week dynamic, what you want to do is now go multiply this by the number of weeks. So if you're looking at 52 weeks in a year, and this is in 3-week increments, that's going to be like 17.33. So you would take the 1.233 times 17.33 to get the annualized return, and that equals a 21% return. Well, that's okay, but it's not the greatest because if you consider how you can see your money grow if you just put it in the SPY, it'll typically grow anywhere from about 8 to 12% per year. Now, last year it was more aggressive. It was over 20%. So 21% isn't bad, but if you're going to be selling options, you want to shoot at least for a 30% annualized return. So we know what we'll get if we were to sell the $60 strike at this point. Now, let's go look at the leveraged counterpart and see how the figures change. Now I'm looking at the chain for PTIR. And remember, we had seen the various strike prices. It was looking like something around 89 would be the equivalent of $60. So I've got 2 selections to make. I could either go with the $90 strike price, or I could go with the 85. There's nothing that's the exact equivalent. And I guess it just depends on the risk that you're willing to take. Let's take a look at our deltas. It looks like on the $90 strike price, the delta is 0.1, and then on the 85, it's actually below 1. I'm comfortable right here at the $90 strike at this point because it's still well below the 0.2, and I think this would still be a fair risk to reward because if I were put these shares at the $90 strike, that would mean that Palantir is trading $60, and I would anticipate that that would change rather soon so that I would then be able to start selling covered calls against these shares if I were put the shares. So if I go with the $90 strike, now this is going to take $9,000 because I'm dealing with a higher priced stock or ETF in this situation. However, I am getting paid significantly more, $352. So I would actually get $352 if I were to select this strike price and put up the $9,000 to make the trade. Let's calculate what our return would be if I went with this instead. You take the 3.52 and you divide it by the price, which is $90. That equals 0.039 multiplied by 100. That gives you 3.9%. And then I would multiply that by 17.33 for my annual return. That would be a 67.7% annual return versus the 21 going with Palantir. And the beauty of it is I'm not increasing my risk. I'm going with the leveraged counterpart, and I am able to triple my return from 21% to 67%. It's making moves like this that allows me and my community members to outperform the S&P time and time again. Don't you love finding trade hacks that allow you to double your premium, but yet not take on additional risk with price action? Please, everyone, do me a favor. I want to continue to make content that is important to you and that will help you in your trading journey. Can you just please comment one ticker symbol? That's all I need. Put one ticker symbol in the comments so that I can read through them. The ticker symbol that I see the most of, I'll make sure that I work that into my very next video. So if you would please do that for me, I'll get to working on the next video for you. Now, if you liked this, I want to show you one more video I did on Palantir. This one's really cool. It's one of my more popular videos, and it really will open your eyes to how many different ways you could trade a quality stock. You can watch that video right here.